answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you're with us this weekend day or whenever you're listening to us as we're talking about financial matters. Both myself and my co-host, we are both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays with helping people like yourself get their financial lives in order, and we spend our weekends, we broadcast this
on the weekends.
Yeah.
So what happens is if you call our show, we will take your name and number, and if you want to join us on the show, they actually call you back and say, "Hey,
we schedule callers.
We'll schedule a call," and that's how we get these calls.
And we like doing. Frankly, we love the call-in format because one, it gives us a place where we can come and answer questions to people, and clearly we have no dog in the fight, right?
We have an opinion as to the value of financial planning, but we're not
trying to sell anybody.
Yeah,
we're not trying to sell anyone on our services. We're just providing advice.
But if you wanted to use our services, it's allworthfinancial.com.
It doesn't get any better. Trust me on that. But
allworthfinancial.com. Okay. But we're not going to try to sell you on our services if you call the show. But this way, we can come in during the week and we actually tape the show.
Right.
After doing it live on the weekends for 23 years.
The point is,
call the show, 833-99.
We're happy to handle any financial question and think of us as another resource. Someone's trying to recommend a product to you. Like it's the financial. It was Pat, as you like to say, if the financial, what do you say about that?
Yeah, if the financial services industry was the food industry, most of America would be dead because it is just filled with.
It's unbelievable.
Yeah, it's just filled with so many garbage products and terrible advice. And to give you an example, bike riding with a friend of mine, and he invited another couple that were friends, and we're on a 30-mile bike ride, and we stopped for lunch because it's all part of the bike riding experience, social. And we're at lunch, and she said, "What do you do, Pan?" She goes, "Look, my friend's wanting me to invest in this. What do you think?" And I'm like, "What is it?" And she goes, "I'm not sure, but the account minimum is $250,000. And I said, "Pull up their website." She pulls up the website, and it says, Second Deeds of Trust.
Oh, you've got to be kidding me.
Second Deeds of Trust. And the friend that
which are essentially second loans on
people
homes.
That can't
get a loan somewhere else.
And she's like, "So my friend's really encouraging me to put $250,000 in."
I haven't heard anyone recommend those in years.
So I said to her, "Not a chance. Do not do this. Don't do this." But because it was coming from a friend of hers that was making the recommendation, and she couldn't tell good from bad.
No, I know.
She just couldn't tell.
Look, that's why, but I guarantee you the person selling the deeds of trust was getting some sort of commission.
No, there's no question.
It's so important to work with a fiduciary, someone who has a legal obligation, not just a desire, but a legal obligation to put your interest ahead of their own.
And you want something, if you purchase something, you want it to be able to price every day. You want to know what it's worth, and you want to know that you can get out of it without penalty. Without penalty. At any time. At any time. If the investment product that you're being recommended doesn't allow you to go to cash.
And look, Wall Street's brilliant about packaging things up and putting them in little small pieces and allowing people to invest in them. So the question is, if it's not available that way, then why is it? And what incentive does this person have in recommending that to you?
Yeah.
The second deeds of trust. I mean, let's say you invested in 10 of them and one goes south on you.
There's your whole return.
For a few
all
years.
Right? All of it. So anyway, we are adamant, you'd say probably hyper sensitive to how difficult it is for the average American to get good advice. And we're not the only firm in America, obviously, that gives good advice. But it's hard to tell good from bad. And I think it's really, really important that the consumer be able to tell good from bad. But there's a couple of barriers that you look at. What's the educational background of the person or organization, the people in the organization you're working with? What's the structure of the compensation? That's a huge issue right there.
And then if they're fee-based and have zero incentive to recommend one product over another. I mean, our advisors, whether they recommend government bonds or some individual stock to somebody or anywhere in between, their compensation does not change one iota.
It's the same.
So they're not incentivized to sell you something. All they want to do is help you out.
If you'd like to
There's
join
a lot
the
of
show,
other firms like that.
If you'd like to join the show, 833-99-WORTH. That's 833-999-6784. And then let's go to talk with Jeffrey in the beautiful state of Minnesota.
Hello, guys. How
Hi,
are you
Jeffrey.
doing?
Good.
So my question is, I was recently laid off and am actively looking for a new job, but unfortunately, my savings wasn't ready for a layoff. So I'm kind of short on cash right now. But I have $400,000 in my 401k. And I'm wondering if I can't take some of that out, pay off the rest of my mortgage, which is at $70,000. And then when I do get my new job, just increase my payments into 401k to make up.
How old are you, Jeffrey?
52.
And are you married?
Yes.
You have kids in the house? Or still responsible for some way?
We're raising our granddaughters, who are 5.
Are they twins?
Yeah.
Wow. Congrats.
Thanks.
I'm sure there's a blessing. Probably wasn't what your plan was, but I'm sure you're quite blessed by having them.
No, you should not take the money from your 401k to pay off your mortgage.
The challenge is, so you've got a short-term problem, and it's probably it's a little scary right now, right? It's the job market is so strange. Was your layoff COVID related?
Yes.
Okay, so
you received some sort of a government subsidy, severance, something along those lines?
Unemployment?
I applied for unemployment, and
how much money do you have in the bank?
We have about $15,000.
Okay, and your wife, does she work outside the home?
Yes, she's a secretary at the elementary school.
Okay, and does she have a 403B or a 457 or a 401k?
Yes, she does.
And how much is that balance, you know?
I think it's about $50,000.
Okay.
I would rather see you take a bit of a hardship withdrawal for a couple months worth of income from the 401k.
Can't, though. He's separated from service.
Under the COVID, he was impacted by COVID. You could take out up to $100,000.
I thought you had to be employed to do that. Am I wrong?
The IRAs. You could take money out.
Oh, got it,
Yeah.
got it. Why wouldn't you just borrow money from the wife's 403B? And that way you could pay it back.
Well, that's even a better idea.
Thank you.
Okay.
Your wife, so I totally understand where you're coming from. Here's our challenge, and here's why we don't like the idea of you taking the money out of the 401k. A couple reasons. The most important reason is these dollars, there's gonna be a day in your life when either you don't want to work or you can't work anymore physically, or right. I mean, that's reality. So you need to have money there when that day arrives. So taking money out of a 401k for a short-term fix is going to be the cost to your retirement. We could run all the numbers, but it would be detrimental. But secondly, is the taxation. This is a year when you've got your severance. You probably eventually have some unemployment, hopefully before the year's up. And then adding this income on top you're going to be taxed at a higher tax rate. So it might take you, if your mortgage is $70,000, it might take you $105,000, $115,000.
So that's why initially we said, don't worry about paying off the mortgage. That is a long-term debt, and you're trying to pay it off in a short term that may or may not help your overall economic system.
Again, I understand your stress right now.
We're not worried about Jeff in next year or the year after. We're worried about Jeff when he's 65 and 70 and 75. So what is the rule, Scott, regarding the do you remember?
You can take out up to $100,000.
But you cannot repay it back, or you can repay it back?
Up to 3 years to pay it back.
So,
but if you borrow some money from your wife's 403b, what kind of industry were you in?
Contract manufacturing, electronics, software.
And do you think you'll go back when? Year? 6 months? Do you have any idea?
Hopefully within a month.
Okay. So I wouldn't do anything. I wouldn't do a thing.
Okay.
I wouldn't.
And if you say I'd like another $10,000 or something in the bank to feel more borrow from your wife's 403b.
It's the easiest to borrow from,
and you can pay it right back once you get a job.
Yeah, and you can pay it back out of her paycheck. That's the easiest place to go to. And then the $70,000 mortgage, when you go back to work, you could talk about it then, about paying it down. But I wouldn't, I'd probably pay it down over the next, 5-10 years. I certainly wouldn't go into the 401k, take it all out, pay taxes on it, and then pay down the mortgage.
Okay.
So, and I know the stress, if that was a way, you'd be better off, but financially it's not good for you. So if you need money right now, use the money in the bank, then go to the wife's 403b at the school district, then go
tap into that retirement
and
savings.
then tap into the retirement savings with the idea of paying it back over the next 3 years.
Okay.
All righty.
Yeah, glad you called, Jeffrey.
Thanks.
And good luck in getting a job.
Thank you.
And by the way,
thank you.
By the way, have you adopted these children?
We're legal guardians, but not adopted.
All right. Just remember that when you go to apply for Social Security, depending upon their age, and when you take Social Security, they may be eligible for some benefits under your Social Security, depending upon their age. Time you start. Just remember that. And the reason I mention that is we see lots and lots and lots of grandparents. I shouldn't say lots. We see lots of people in their 60s that are raising nieces, nephews,
or
grandchildren, or even their own. And they oftentimes forget that if they're on Social Security, a child under 18 is also eligible.
Mick Jagger's kids are probably collecting Social Security.
I wonder if Donald Trump's son is getting Social Security benefits.
Donald, I bet he is. What do you think?
I know. I wouldn't blame him.
He must be, because because I'm sure Donald Trump's on Social Security, right?
Yeah.
And if you've got a minor dependent a minor child, you wonder why the Social Security Trust Fund is getting.
Yeah, because it doesn't matter how much money the parents make.
No, of course not. The kids get money.
Yeah, Barron. That's how he dresses so nice, that Barron.
I don't know why that's a weirdest rule.
It is. There's no means testing at all.
Well, the fact that why is the kid, just because someone's on Social Security benefits, why do their kids automatically qualify?
It kind of encourages old people to have children.
Or to go find a single
young wife with adopted kids.
There it is.
That's social engineering.
That's someone who's broke in retirement. We could show a 70-year-old broke man how to go.
Right. So here's what I want you to do. I want you to marry a 35-year-old with 2 kids under the age of 6.
Or the more kids, the better. Get the maximum family benefit out of it.
I think we've taken this a little too far.
I think we have too, yes. We are obviously totally joking in this area. It's just, it's kind of bizarre where those things are. Yeah. All right. Let's continue on calls here at Allworth's Money Matters. We're in Colorado talking with Tristan. Tristan, you're with Scott Hansen and Pat McLean.
Hey, guys. How you guys doing today?
Fantastic.
Awesome. So I had a couple of questions. The primary one that I wanted to ask you guys about was restricted stock units. I received a grant back in April of this year for 60 restricted stock units for company stock. And my question, and then I received a second grant here last month for an additional 39 restricted stock units. So I'm just really curious. I don't have any understanding or knowledge about restricted stock units apart from what I've read. And my main question is about the taxation on those and when it's due and, how you go about paying that on these when these vest.
Yeah, and restricted stocks, RSUs, they're called now. It's pretty it's a modern day of stock options.
Stock options, or some companies will call them management incentive plans or equity incentive plans, but that's essentially they're all of the same family.
Is the company you work for a publicly traded company or no?
Yes, it is.
And what are the dates? Do these have expiration dates on them?
So there's a vesting schedule. So the first grant of the first 60 that I received, the first 20, so it vests 20 shares over the next 3 years.
Okay, thank you.
Yep.
So 3 year vesting schedule.
Yeah.
So as the name implies, restricted. The restrictions are designed by the company, and it's going to be part of the plan document when they've come up with these restricted. So they all work slightly differently. The vast majority of time, there's no taxation until you exercise your right and sell these stocks.
And at that point in time,
as long as you've had it for more than a year, it's long-term capital gain.
As long as you've had the RSU for more than a year.
RSU.
For more than a year.
Yeah.
Okay. So I'm only liable to pay any taxes on these grants when if I indeed sell them.
If you indeed sell them at a profit above and beyond their issued value.
Okay. So the other question I have as a follow-up to that, so my account is showing potential value. So is the price determined at the time of the grant or at the time that it's vested?
At the time of the grant. I haven't seen
the strike price is determined at the time of the grant.
Yes.
But not the sales price.
So,
that's based upon the market.
So
that correct.
So it's like the purchase price. So essentially, in reality, is it the company has purchased these stocks on my behalf at whatever the strike price is at that time, and then they essentially issue them.
Probably not. No, they're probably just treasury stock. It's probably this. I mean, these are all set up differently, but odds are it's just an accounting mechanism that they're using to incentivize you. It's probably more of actually an interest in the earnings of the company. And the way they structure that's called an RSU.
Yeah. So what was the strike price? The price they gave you should be very close, if not identical, to where the stock was trading on the date they were issued. Is that the case?
Okay. Yes.
Okay. So that is the strike price. Anything above that is where you're going to be what they call in the money.
Okay. So essentially, if the price of the stock continues to increase as it has,
yes,
between when I was granted the stocks and when they actually vest, I will see all of that gain.
That's correct.
All of
that is the whole idea behind the incentive of these, and that's what can work in your favor.
Okay, but I'm only due taxes when and if I sell those stocks.
When there's a triggering event on that, yes.
Yeah.
Awesome. So the second question I have is that we do have an employee stock purchase plan, and I'm just curious what you guys' advice would be in terms of investing in that, doing payroll deductions to.
Do they give you a discount?
Yes. So they have. I'm not. Fully understanding of when we have the buying period, and then we have to build, and then we have when they actually put that into your account. But it is whatever the best price.
Okay.
The
that
better
quarter,
price
that
between
6
a
months,
certain
whatever.
period.
Yeah.
Yes, and then we get a 15% discount on whatever that best price.
Oh,
So
okay.
you get 15% of whatever the best price is for that previous quarter. And when can you sell the stock?
And if you do sell the stock, are you prohibited from participating in the next round if you do sell the stock?
No,
Okay.
I'm not.
And
not
can you
prohibited.
set up?
So
Can you do like an auto sale program? I've seen people where they can literally sign up for these company stock purchase programs, get this discount, and sell. And whether it's a quarter or 6 months or a year, automatically sell the stock right afterwards. They take no market risk, and it's like it's a guaranteed 15% return the way it's structured.
Yeah. And I've seen people do it where they hold them for a year and then take those shares and gift them to charities because it's a way that they can constantly give to a charity. So the answer to the
From
question,
a highly tax efficient basis.
correct. So the answer to the question is yes, you should participate given that you have the liquidity to do so and that you understand the restrictions going in and out and the risk. But for most, we have never, almost every time that you see a 15% discount and you feel bullish on the company itself, you would participate in that.
Okay.
Yeah. And by the way,
Yeah.
But you got to make sure that, how old are you?
41.
Okay, so here's, us financial advisor types, we always talk about diversification, right? Diversification. Diversification is great at minimizing risk. Diversification is highly important at retirement time,
Yep.
and it's important for those dollars that you can't afford to lose. But if you, let's say, you worked for Apple for the last 30 years, and every time your Apple stock was more than 4% of your portfolio, you decide to sell it to be diversified, you would look like the biggest fool walking around campus there, right? That round campus
or
that's
Google,
empty.
right?
Yeah, or Google or whatever, right?
Yeah, right.
So when you're younger, you can afford to take on some risk, particularly if you're with some company you're feeling pretty confident about. But then the older you get, the more you need to say, hey, there needs to be a big chunk of my net worth that is diversified away from this company because you never know what can happen.
Right.
There could be some strange financial accounting scandal that's happened.
WorldCom.
What's the latest? That huge international company.
Yeah,
It's
yeah.
not much here in the U.S. Payments,
Yeah.
big payments company. So so as you think about that, you want to make sure that you're in a position so that if the company doesn't performs poorly, you're not going to be in the doghouse.
And Jeffrey, we assume you've covered the basics, like you put the maximum to the match in the 401k. That's an assumption that we just made off the bat. Buy these and the RSUs. I wouldn't get too excited about the RSUs. There's not that much there. It's 100 shares. Track it. It's not life changing. It's nice that they gave them to you, but I can't imagine that you could get super excited about 60 RSUs.
Yeah, I mean, well, there's 99 right now because I got a second grant bonus.
Correct. Unless the stock's
last month,
trading
so-
for the hundreds and hundreds of dollars.
Yeah, the value's about the total potential benefit value is about $25,000 right now. So that's not bad.
That's not bad. That's not bad at all. Anyway, so we like both those.
Yeah.
Like both of those. So
Awesome.
All
Thank
right.
you so much, guys. I really appreciate it.
All right, glad you called, Tristan. It's interesting, Pat. I think there's almost a bit of a new wave for some companies offering some sort of restriction, but it's different. Think back in the 90s, stock options were all the rage. You work for a tech company; they all had all these different stock options.
yes.
Widely distributed to every employee would get stock options, every one of them, and that's really changed over the years. I don't know if it's the fact that companies think maybe it doesn't influence behavior. If someone's job is to work in the mailroom and they open mail all day long,
Are they going to open mail faster?
And I'm just picking out a certain kind of repeatable job type thing, but
yeah. Anyway, good for him. Good for him. By the way, I don't know if there's many mail rooms and companies left. It's the email room. They work in the email room.
I saw Elf. They had the mailroom at Elf.
Oh, one of my favorite movies.
It's about that time. I hate to say it.
Oh, one of my favorite. Buddy the Elf, what's your favorite color? All through the holidays, that's how I answered the phone when my kids call.
What?
Buddy the Elf, what's your favorite color? When the Elf was visiting his dad in the office, and his dad left the office for a minute, the phone rang. Buddy the Elf picked up the phone and said, "Buddy the Elf, what's your favorite color?"
That's your little bonding thing with your kids. That's the Christmas time. That's always what it is. You see that, you know it's them. It's Tommy. Hey, Buddy the Elf here.
What's your favorite color? That's how he says it. Anyway, great movie. Classic. It'll go down as a classic.
Oh, there's no question.
Yes.
Yeah. Do you know how many bad movies are produced for everyone that like that? Why is that?
I don't know.
But most of the Christmas movies are downright painful.
Yeah.
There's a good one every once in a while. Anyway, we're going to take a break. When we come back, we'll take some more calls. So if you'd like to be part of Allworth's Money Matters, 833-99-WORTH is the contact number. Again, that's 833-99-WORTH. This is Scott Hansen and Pat McClain of Allworth's Money Matters, and we'll be right back.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain. Thanks for sticking with us. And I do have a favor to ask. If you are listening to this in a podcast...
You're going to ask me a favor.
Not you. I'm asking the listeners. If you're listening to this in a podcast forum, would you be so kind as to go to, if your particular podcast has a rating mechanism, would you be so kind as to rate us? The higher our ratings, and I'm assuming that if you're listening and you're halfway through the show, that you might have a slight interest in it and you might like it. That's my hope, that you would rate us or
review us, you mean?
Review us and share it with a friend if you are so inclined.
I saw an article about health savings accounts. Only 6% of account holders invest the savings in their savings account. So most of them are just in bank accounts?
Yeah, that's actually higher than I thought it was.
6% of account holders.
Okay.
If you have a health savings account, think of it like another IRA. Because for a family, next year you'll be able to put in $7,200 into it.
Mm-hmm. And you don't have to spend it. You can pay for the copays for your health insurance out of pocket.
That's what I do.
That's not what I do.
I've personally have invested, our family, as soon as the HSA was the plan that our employer put in place. Actually, we have a couple different options. The option I chose, the health savings account, I've put the maximum in for my family, and I've not taken a dime out. And it's invested.
And you invest what, in the S&P 500? Or
yeah, I've got a couple index funds in there.
And it's probably grown.
Frankly, I invest it for the long term because my plan is not to spend those until I'm forced to.
So you can...
Because it's tax deferred and it comes out tax free. If you leave it there till you're 65, it's tax free. They might change that, but it's essentially...
So the idea behind this is that it's set up so that it is to use the copays, but you don't have to use it. So you can actually invest it in the portfolio and let it run.
And think of it like a retirement account.
Yeah, and I think it's the right thing to do, Scott. I agree with you. If I was going to say
this is a classic. I know where you're going. This is classic.
My wife, I explained it. She's an accountant, very, very smart lady. She likes paying for it out of that account. And I'm like, well, there's some tax benefit in doing
It's
this.
no different than using an IRA to pay your medical bills.
That's right. That? No, I understand that. I do understand it. But
your 401k.
Yeah, and so in the scheme of marriage...
No, I get it. It's an interesting story because if you think about this, here's Pat McClain, been a financial advisor for 3 decades. Your wife's an accountant by training, and she spent the majority of her last 25 years raising children.
Yes.
But this is her preferred way of doing it. And it kind of comes down to behavioral finance things, right?
She's not going to change.
People say, I just feel comfortable having $40,000 in my checking account. That's my comfort thing. Okay.
All right. Right.
If it's a minor thing in the overall scheme of things, who cares?
I let it go.
But I think for a lot of people, health savings account could be
as long as it doesn't ruin your marriage.
How come you got divorced? I told her, look, one more medical bill paid from that HSA, and it's over.
I'm out. 34 years comes down to a tax-deferred IRA.
All right. As Pat's been threatening to move to Nevada for years because the taxes are so much cheaper, and they almost raised the taxes in California, the top rate of 16.8. Pat's like, that's it. And his wife is adamant that she doesn't want to move. And I said, well, your choice. Either 16.8% to California or 50% to Kathy. Those are the options right there.
Right there. So I measured the 33% spread. Decided to stay in California.
She's worth the 33%.
She's worth it.
Not 33% spread. All right, let's take some calls here. 833-99-WORTH. Let's talk with Benjamin.
Yes, thank you for taking my call.
Yeah, thanks for joining us.
I have a situation where a close friend of mine, is telling me that she wants to, and I'm not sure I should mention this person's name on your show.
Well, maybe not then.
You're right. Into something that is a whole life.
Oh, you're not going to mention your friend's name, correct?
No.
You're going to mention the name of the person that's selling it?
Yes.
Go ahead.
If that's okay with you?
Sure.
Well, she has gone head over heels over somebody named Chris Noggle.
I don't know who he is. Never heard of the man. But let's talk about what the product is, and we will not either encourage or discourage Chris's what he's doing for a living. So we're not going to disparage him.
We might
in any way.
We wanted him.
We won't disparage him, but tell us about how this whole life works.
Allegedly, she is going to invest about $200,000, and he is saying that the return is 10 to 12%.
Okay.
She is leading into saying she's going to get a return of $3,500 a month on that money. The research that I've done appears to me that we're not using the word annuity, but that sounds like what it is.
Kind of. So if they're actually using whole life or variable life rather than annuity, what they're talking about is how you put your money in there, and that grows tax deferred, but you could draw your basis out, which is because tax law around life insurance goes in FIFO, which is first in, first out, versus LIFO, which is your earnings first. I wouldn't put a penny into this. Not a penny, not penny one. Did they talk about the 15-year surrender charge? They talk about the high commissions to the broker. Was any of that brought up?
Well, I think it's being, those things are not being said to me.
Okay.
Because, yeah.
So here's what your friend wants to do.
I mean, that's 42,000. I actually had to use the calculator because
I know it's 42.
It just seemed too.
Yeah,
like,
it's 21% a year.
I mean, there's always that kind of saying, like, if you're.
It's 21% a year. Is what the numbers that they just said. $42,000 a year.
How old is your friend?
$200,000.
In her mid-50s.
Okay, so
if she was in her mid-90s, then you could say, yeah, it's a life annuity she bought from someone.
What they're selling, you're 100% right. So what you want to do is you ask for a sample contract and take and Google the person's name or the life insurance name, and then write complaints, scams around that name and see if there's anything that comes up.
There may or may not be.
There may or may not be. I do not know the man you spoke of, but I know how these life insurance policies are sold. And what they're sold is some sort of magic elixir that the Rockefellers and the Kennedys and the Montagues, all of them used it, right?
Yes.
Back to Victorian times. This is how the wealthy.
So life insurance, and what happens? Life insurance, strong lobbying. They've been able to maintain some tax benefits, and basically money invested in a whole life insurance, as long as you follow There's certain guidelines you still have to follow. You can't throw too much cash in at once. But if you follow the guidelines, the money grows tax deferred internally, and then you can borrow out your earnings without paying any taxes on it.
Yeah, you take out your basis first, and then you borrow
Your
out
original
your
investment.
Yeah.
You can take out your original investment first, and then that earnings you can borrow out, all theoretically. But the challenge is, the question I would ask your friend is, where does she think the insurance company is investing their money?
Where's that money go?
Right. They have to be gaining somehow.
Right.
Yeah, well, they're
Benjamin,
buying
and they live in the same world we live in, right? So they have the same.
Exactly.
I mean,
Actually, and their portfolios on whole life policies are mostly bond and real estate.
which are very low. Right?
So my guess is that she wasn't going to get the $3,500 a month now. She was going to get the $3,500 a month in 20 years
earn
from
10
now.
to 12%, and it might be in a variable. It might
Even
be a
then.
variable life. That's why he's quoting the 10 to 12%.
If she needs life insurance, have her buy some inexpensive term life insurance policy.
Do not buy two, but do not. The worst thing, this would be terrible for her.
Awful.
Terrible.
And she can't reverse it.
Terrible.
That is exactly why I called.
I've never seen it. Here's the thing. I have never seen it actually work out the way these life insurance salesmen talk. I've seen people that have been older that have had phantom income they've had to report because of what's happened with an insurance policy that's has lapsed because they've borrowed money out of it. I've seen people, most oftentimes, people put money in, their life changes, something changed, they realize it doesn't work out quite like they thought it was going to, like someone sold it to them, they want to get out, and they've got massive surrender charges. Massive.
Right.
And I would ask also what the commission would be to the broker agent who's selling this thing.
Yep, I'm writing.
What is the commission? Ask her to have it put in writing. The guy's going to scream.
So what your friend really needs is probably a good financial plan. That's what she really needs. She's looking for product.
Yeah, I mean,
and my guess is
she might be looking for someone to give her an answer that she wants to hear.
that could be
She
true.
might have talked to lots of people that have been really.
If she has $200,000 laying around, it might be one of the best things for her is to pay down her debt. Most certainly increase her contributions to her Roth IRA, or
I would say the
401k.
vast majority of people who, particularly if you inherit money or something like that, pay down debt. It's not easy being an investor. It's really not easy being an investor because, one, you've got to be able to distinguish between someone trying to sell you crap, garbage, and what's real out there. Then you have to have the patience when things aren't going well to stick with the original plan. And then when things look horrible, like when a pandemic hits and the markets fall 40%, or when there's a financial crisis, you have to have the thick enough skin not to be frightened and sell out at the wrong times. It is very challenging being an investor. It's not easy, which is one of the reasons why if you come in some cash, sometimes your best investment is just paying off some debt that you have.
Yeah. What was the source of the money?
The source of the money had been termination, a divorce.
Okay.
Oh, gosh.
Well, this is the worst thing she can do.
And here the problem is, Benjamin, she's looking for a solution to her need, right?
Yeah.
She needs $3,500 a month.
This guy said he could do it. It can't
be done.
Can't be done.
It's not going to get 21%. And the fact is she might not, $200,000 is not going to go very far. She might not find a solution to her need. And it's not, at least not with an investment. There might be enough to cover her for a few months when she tries to figure out how to move forward with her life, but it's not going to be enough to generate anywhere close to the kind of income she's getting. And I've often said that the world would be better off without whole life insurance, not because it is not appropriate sometimes, but because it's missold and misused like this. And for the life of me, I don't understand why there's companies out there that would even sell someone a policy like this. But
you mean for the life of you why they would? It's a big commission. There's huge margins in it.
I know. Continuing on here, let's talk with Bob. Bob, you're with Allworth Money Matters.
Hello.
Hello, Bob.
Scott and Pat, right?
Yes,
yeah,
sir.
That's it. It's called the.
Hey, I got a question for you. Just read in the newspaper, I shouldn't say just read, but a few weeks ago there was newspaper article that basically said that the insurance companies were going to be paying out $2 billion plus in claims associated to the unrest we've had throughout the U.S. And now, on top of that, I'm, of course, reading of all the fires and homes and buildings that have gone up in California and probably other parts of the nation as well. So, question for you is that annuities, how safe are these annuities, which I understand are pretty much backed or issued by insurance companies, and what kind of impact is that going to have on the payouts of these annuities?
It should have little to no impact on them whatsoever.
Okay.
I mean, the insurance companies have quite a bit in reserves. I think the risks for insurance companies is the fact that insurance premiums on all products are going up, even products that don't relate to that, things like life insurance and auto even, because the insurance companies, they can't make as much on their reserves as they used to. They live in the same world that we do, right? Interest rates are so low. That has been...
But that isn't as a result of any...
That's, I see the bigger risk, though.
Yeah, but that isn't a result of any public unrest or the fires. That has to do with just the fact that the yields on the reserves are so incredibly low, which will affect the annuities, which will absolutely affect the yields on the annuities because what? And you're talking about fixed annuities, correct, Bob?
Correct.
Okay.
Do you have money in annuity contracts, or do you receive a monthly income from an annuity company, or?
No. To be quite honest, I read your articles, and in the past, you have always swayed away from purchasing annuities because of the expensive.
And you trying to give me some more fuel behind that argument?
No, I read what you publish.
Okay.
I read it. I've listened, and so then my concern, of course, is of other people that have purchased these annuities.
Okay.
And, be honest, I mean, I'm seeing ads on TV. I've got friends that are always trying to sell me these things, and I've always, to this point, said no.
So they are there's no FDIC limit like there is with banks. So the federal government does not have some program to backstop. There are state programs where the insurance companies all pool together and share in some risk in state programs, but their limits of what, $250,000 per contract, something like that. So
what happens is when you purchase an annuity, if not you, Bob, but
I mean, if the insurance companies go bankrupt, it's a real problem. Remember back to First Executive Life. Was it First Executive?
Yeah,
Executive Life?
Executive Life, but that was chock full of high yield.
Junk bonds, back in the day.
Junk bonds.
That was
so what happens is insurance companies are much more regulated than they were 30 and 40 years ago. So what happens is if you give $100,000 to an insurance company, they turn around and invest it. And what they invested is typically in corporate, high-grade corporate or U.S. government bonds. That's typically what they invest in. And they essentially take a spread or a little bit of money off of what the bonds are yielding and what they're paying you, and that's what they will call their profit. Well, the only thing an annuity is doing for you as a consumer is protecting you from the visibility of that bond going up and down on a daily basis or going bankrupt on a particular bond. So an insurance company, if you will, an annuity, if you think about this, if it has a 10-year surrender charge on it, I buy $100,000. What do? They go out and buy these bonds for 10 years they invest it. What have they done is I've essentially bought a mutual fund that's kind of blinded to me because I can't see the volatility on a day-to-day basis, and I can't get my money out without a penalty. That's about it. So what you're seeing is index annuities. There's a lot of advertising on that. You're going to see index annuities, the benefits get much, 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 much worse, and the costs go up significantly in index annuities for two reasons. One that Scott just spoke of is that the cost that the yields internally on the bonds are going down, and the instruments or options they use inside of those annuities in the market to give you quasi-index returns are going to go up in cost. And that's a normal part of where we are in this market cycle. So I appreciate the fact that you don't own an annuity. I appreciate the fact that you actually called and asked us the question, are companies going to go bankrupt? It's highly unlikely that the companies that are issuing annuities are going to go bankrupt, but the products still remain garbage. So I appreciate the call.
Yeah.
All right.
Still not. Still not.
So the claims that they pay out then will have no bearing upon them.
Well, I don't. They're not paying out to. They're not going to be insolvent based upon
that. Because what happens is that big insurance companies that are actually in that marketplace, typically there's kind of a line between those two divisions inside of that company, and they have reinsurance behind them for property and casualty claims.
They insure one another.
Yeah, and so even what the reinsurance companies actually reinsure one another, and insurance companies will reinsure each other. So what they're trying to do is spread risk as far wide as they can. And that cuts into the more risk they retain, the more profit they typically will make over short periods of time, but the more volatility it actually puts into their financial stability. So appreciate the call.
Yeah, wish you well, Bob.
And that is, nothing gets better than a good insurance discussion, does it, Scott? And now, boys and girls, let's talk about liability insurance.
And finally, we're in Reading talking with Jeff. Jeff, you're with Allworth Money Matters.
Yeah, hi, Pat and Scott. How you doing today?
Good, Jeff. How are you, sir?
Yeah, I'm getting ready to transition into my non-work phase of my life, and I just kind of wanted to run some numbers by you to get your opinion.
Sure.
Long-time listener, all the way back in the 90s, so I really value you guys' opinion.
All right, fire away.
Yeah, I'm 55. I have a pension. My house will be paid off in 5 years. I'm single, no children. I plan on leaving service from my school district at the end of January and basically just living on pension income. And I have a 403b7 through the school district through Vanguard.
How much is that?
And I have an HSA with $36,000 in there, and I have a brokerage account with about $16,000 in there.
And how much money is in the 403b?
Yeah, right now, depending on the stock market, it has about $480,000.
And are you planning on taking income from your 401k to help supplement income your needs, or is your pension going to be enough for you?
My 403b, I don't plan on taking anything from that because you have to be age 59 and a half. I know they have that equal 5-year period distribution, but I can live comfortably.
Well, actually, that doesn't apply to your 403b. So you could get at it if you're 55 or older in the year in which you separate from service. But so how much is in your brokerage account?
About $16,000.
$16,000. And how much money do you have in the bank?
Right now, out of that brokerage account, I have about $9,000 in liquid.
Okay, and how much do you owe on your home? You said you're going to pay it off in 5 years. What do you owe?
Yeah, right now I'm one of those weirdos. I have an amortization schedule on my refrigerator, and I mark it off each month. I'm at $50,000 right now.
Okay, and how much will your pension be?
$3,100 before tax.
And what did you earn last year?
About 43.
43,000 a year?
So I'm not a high income earner.
Well, so your pension is replacing.
Holy smokes! You did awesome, and you're not one of those weirdos that keeps an amortization table on your refrigerator. You are.
I am one of those weirdos that does.
No, you're brilliant. Have you called our show before?
Yeah, in the past. I'm a long-time listener of you. I've gleaned so much valuable information from your organization over the years.
For whatever I remember this guy in Reading calling, and I was impressed by the fact that he didn't make a lot of money, but was a great saver. I like your plan.
Yeah, because your pension's, but you're not, considering what's coming out of your paycheck today, that's not going to be coming out of your paycheck, your pension's going to replace the vast majority of your income.
I love your plan. I love it. So what's your question for us? Or
I just wanted to make sure I have all my ducks in a row
Yeah.
before I push off.
Yeah, you're in good shape.
Here's my only thing that I would worry about with you is how you're going to fill your day.
Oh, I'd like to hopefully provide free financial education to people because it's very lacking in our country, regardless of your social economic level.
I think that's actually, something? Dave Ramsey, who has a show that provides financial education, has programs where he teaches teachers how to teach the Financial Peace University. And I bet if you looked around, there's one up in at a church near you in Reading. And
I'd like to do that because in our country, I think people really need it.
Yeah. Now but financially, you're great. And
by the way, if you're over 55 when you retire, 55 or older,
right,
you can take money from that 403b7. You do not have to wait till 59 and a half. 59 and a half applies to IRAs or if you retire before age 55.
So what happens is on that 403b, in fact, Scott, I don't even think the 55 rule applies anymore on a 403b. I think that's just a 401k, but don't quote me on that. Do not quote me. But we know 55 or older, you can take the money out of the 403b without penalty.
Once you retire.
If you move it into an IRA, then that's when the series of
the 5 year or it's locked to 59 and a half.
Yeah. So by leaving it in
one last question before I leave you.
Sure.
I plan on funding my HSA from now till age 65.
Yep.
And what I did this year was I moved to a high deductible because the bronze plan I was on at my school district wasn't HSA compatible, so I moved up. And I've fully funded it for this year. Even though I didn't have coverage in January, February, March, April, or May, there's a section in there that says if you have coverage by December 1st of that year, you can go back. So my plan is to try to fully fund the HSA, not necessarily for the tax benefits, but just for money in the future to try to mitigate
I maximize mine.
costs.
Yep. What's the interest rate on your mortgage?
Thank you very much, gentlemen.
Jeff,
I just wanted to have confirmation.
Jeff, what's the interest rate on your mortgage?
I have it on a 10-year, and it's 2.39.
Wow. Dang it, you're brilliant. You are smart. Holy smokes.
I'm thinking you're asking him. You know that. I'm thinking you already knew the answer.
I knew this guy.
He wasn't going to be, I haven't refinanced in 12 years. Should I?
You knew
I'm paying 8.5%. Is that high?
No, this guy, there was not a single thing wrong. Not a single thing, Jeff. Not a single thing. You could not poke a hole in any of this, my friend. Congratulations.
Well, hey, we are out of time. It's been great being with you. We'll see you next week. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.